If I handed you $10,000 today and gave you 4 buttons to press index fund, mutual fund, hedge fund, or ETF, one of those buttons would probably make you richer, and one should not be anywhere near beginner money. Wall Street explains these products in a way that makes the simple one sound boring and the expensive one sound smart. If you are new to investing, here is the only idea you need first. A fund is just a basket. Instead of buying one stock or bond by yourself, you put money into a shared basket, and that basket buys many assets for you. The first button is the index fund. An index fund does not try to be clever. It copies a list. If the list is the S&P 500, the fund buys the companies in the S&P 500. That is why index funds are powerful. They are cheap, diversified, and over long stretches they beat most fancy managers because they do less and charge less. The second button is the mutual fund, and this is where beginners start getting fooled. A mutual fund is still a basket, but usually there is a manager deciding what goes in and what comes out. That sounds impressive, and sometimes a manager wins for a while, but the problem is fees. When you pay for a manager, you pay every year whether they win or not, and over time that fee eats your returns. The real trap is assuming expensive means safer or smarter. Most actively managed mutual funds do not beat a simple low-cost index after fees. So a beginner often ends up paying more for complexity, more for marketing, and more for the feeling that somebody important is watching the basket. The third button is the hedge fund. Hedge funds use leverage, short selling, derivatives, and other aggressive strategies to chase high returns. They also charge much higher fees and are usually reserved for wealthy investors. If you are a beginner trying to build long-term wealth, a hedge fund is not a starting line. It is a VIP room with a high cover charge and a real chance of walking out poorer than when you entered. The fourth button is the ETF, or exchange-traded fund. Many ETFs are just index funds inside a different wrapper. The big difference is how you buy them. A traditional index fund is usually priced once at the end of the day. An ETF trades all day like a stock. That flexibility is nice, but it is not the main reason ETFs win. They win because many of them are also cheap, diversified, and easy to access. So which button should a beginner actually press? For most people, it is a broad low-cost index fund or a broad low-cost ETF, not because those options are exciting, but because they solve the two biggest investing problems at once. They lower the chance that one bad company destroys you, and they lower the fee drag that quietly bleeds your account for decades. If your retirement plan only offers index mutual funds, that is fine. If you use a brokerage account and want simple flexibility, a total market ETF or an S&P 500 ETF is fine too. The tiny differences between those options are not what make or break your future. This is where people get distracted. They spend weeks comparing tickers and clever fund names when the real questions are simple. Is this fund broad? Is it low cost? Do I understand what is inside it? And can I hold it for years without doing something stupid? If yes, you are already ahead of most investors. The finance world sells complexity because complexity sounds valuable. But beginner wealth is usually built the opposite way. Fewer decisions, lower fees, wider diversification, more patience. That is not flashy advice, but flashy advice rarely makes people rich. So if you remember one thing, remember this. A good fund is not the one that sounds impressive at a dinner party. It is the one that lets your money compound with the fewest obstacles between you and time. For most beginners, that means stop looking for the smartest basket in the room and start looking for the simplest one you can keep buying forever. That choice feels almost too easy, which is exactly why so many people miss it.